In Zambia, there's an interesting development right now. The open market operations with the central bank is aggressively pushing, but that is almost a sort of a mix. You have a perspective on that?
Yeah, I think it's quite surprising when we see the central bank saying that the banks are lending at rates far too high to the corporate sector.
Right.
And through their OMO operations and pushing the sort of short-end rates back up to sort of 13.75 to sort of 14%, comes as some surprise. I mean, they are draining liquidity, which is going to cause rates to remain fairly high. At the same time, they want the rates to be lending at lower rates. Addition to that, we've got the bond market auctions now reduced to quarterly auctions. So there will be excess cash about. But by taking it out the system, it kind of defeats what they're trying to aiming to get at.
Because the open market operation is only open to the local market.
Correct.
It is also tax-free.
Correct. Only open to the local market operators. So
yes.
No offshore opportunities there at all for anybody from outside. And tax-free. And yeah, those are the key things why the banks have got cash, but they're going to go for the 13 and 14%. But rather lend it to the corporate clients, which is what the market needs. I mean,
yes.
We need to look at the growth markets. We're seeing commodity prices coming lower. We're seeing slightly lower copper prices. There has to be a focus on growth, and growth depends on how much the customers can borrow.
If you advise the central bank, what would you have them do right now?
I wouldn't be
Maybe they're
watching.
We'll send them a link afterwards.
That'll be interesting. See if I get back into the country. No, I think it's key to look at what's available on the local markets and what's available then to them to actually then drain liquidity. You know, maybe it's not necessary to be as aggressive as they have been.
Right.
Maybe they need to use the open market operations as a way to take liquidity, but also to try and get rates lower. If they're taking money in 3 weeks at 14%, and the central bank rate is set at 9%, we've got a 5% shortfall there.
They've also changed the bond auctions to quarterly. What is the impact of this with the open market operations?
I think it'll lead to more demand and more bidding when the time comes for the auctions, but the maturing cash through that time. You know, they're using the OMO to mop up some of that maturing cash. They don't want to see a huge demand when it comes to auction time. It's inevitable we will see some strong demand locally at auction time from the pension funds, from the asset managers, looking then with the excess cash, what they're going to do, they're going to go to auction.
For how long can they keep up this, do you think?
Well, I'm hoping they don't keep it up for too long.
Yes.
You know, I think they've taken enough liquidity out. There has been a huge amount of liquidity. Don't forget that foreigners can't borrow any kwacha for less than 1 year. So we can't go in as a bank and fund ourselves for any positions that we have for less than the 1 year period. So all that cash is there only for the local markets. So there is a need to take some liquidity out, but to get it up to 14%, 13.75, I think slightly aggressive.
Because there's also the de-dollarization that is currently ongoing.
That's a process that they started with, and they're going to put into operation, you know, and again, it moves away. I think it's a good thing.
Yes.
You know, if you're going to sell goods in country, you want to sell them at the kwacha price. Create demand for the kwacha, which again is then good for the currency. And
because that allows them then to be able to have their monetary policy actions implemented well.
I think the key thing is that you'll then see demand for kwacha to pay for goods.
Yes.
The monetary policy process is to look at how they can actually get the cheaper rate of borrowing to the client, and also keep inflation in check and remove the dollarization. Remember that removing dollarization adds a little bit to the inflation side,
yes.
But I think that they're going to do well.
Let's talk about the oil price. Coming off quite a bit right now. We're not sitting too badly. What is the impact of this likely for you, for Africa?
I think a lower oil price in general is good for Africa. I mean, we look at our 3 oil producers, Angola, Ghana, Nigeria.
Yes.
Not so good for them, but I think on a whole, food inflation prices should now come lower. I think the strange thing being oil at $120, West Africa is looking good. East Africa is struggling with high inflation.
So now we have the reverse.
It's a complete reverse.
East Africa
is looking better. Food inflation's in check. Inflation's coming down lower. I think that, you know, for the West Africa side, don't forget most of the fuel is still imported as well.
Yes.
It does give room when we look at the fuel levies in Nigeria that cause such a big problem when they try to remove it. The lower fuel price might give some scope to reduce that, to remove that petrol, that fuel subsidy, and by that way, maybe they can then look at the impact then on their food. Won't be as bad as what they first thought.
So apart from the oil producers, everybody else should pray the oil price keeps coming down.
It's looking good for us as well, eh? It's going to cost you less to put petrol in your car. But
exactly.
Look, I think in general it's good. Remember that the budget number set for Nigeria is $77 a barrel.
Yes.
So that's not too bad. I've seen one of your previous broadcasts that talked about increased production in Angola. So
yes.
there are good signs of it. Unfortunately, the danger comes that if the oil price falls too far, that OPEC then come in and try and reduce production, which isn't then the right answer, because it's still going to mean, you know, higher price but less oil being produced, I think the countries will be fine with it.
And let's finish off with the investment side of things. Has there been a change to the wait-and-see policy, especially right now with the risk aversion?
No change. I mean, from our side, we saw the flight to capital take place. We're seeing a bit of a stagnation in the markets now. Things have slowed down significantly. I think everyone's in a bit of a, you know, a European wait and see what's going to happen in Europe. Is there more money going to flow back into Africa on the investment side?
Right.
I think we're getting through mid-year end and year end for some companies. But I think, you know, I think the magic will return once we get more settlement in Europe, and I think we'll see some funds coming back into the high yielders, the more stable countries. Nigeria is always top of the list, so certainly some FDI into Nigeria, FDI back into the Kenyan markets. The other markets slightly slower, but the ones without restriction and decent yields will still see some good FDI coming back in.
So far, my home country of Kenya appears to have the best room to cut rates.
I certainly, I think it surprised me, maybe not so much my research team.
Yes.
Our RMB research team went for no change in rates. On the trading side, I thought there was room for a cut. It didn't happen, so I lost that bet and cost me another lunch, I think.
Don't bet next time.
No, I'm not betting on the next one. But I think there is scope. But again, you know, are they going to save the good news? Are they going to save the positives for closer to election time? I think that's quite a possibility for us.
All right, we'll leave it there. Roy Daniels, always a pleasure speaking with you.
Thank you, Dave.